Good evening and welcome to Mortgage Coffee Talk on Awaz Entertainment. My name is Tahir Qureshi. I'm your host tonight. The topic is first time home buyers mortgage. Recently, I have received quite a few comments from audience viewers, and they want to know if they are first time buyers, what type of uh, things they need to watch and need in order for them to secure a mortgage. The first question that comes to your mind is, am I financially stable? Because that's the first question comes to you when you are seeking a mortgage. If you are financially stable, that means you have a continuous income, you are employed, or you're a business person or self-employed, you have a continuous income. Second thing is, do I have financial management skills and discipline to handle such a large transaction? That means when you are buying a home for applying for a mortgage, you must have management skill how to arrange and manage resources in order to fulfill your obligation as a borrower when you borrow money. Number three, am I ready or able to take responsibility for all costs that comes with owning a home? You must understand when you own a house, not only that you pay the mortgage payment, you also have property taxes, you have utilities, gas, water, electricity bills you have to pay, you have insurance cost. So there are landscaping and maintenance costs. These are the costs that you have to make sure that you have the funds to support it. Number four, do can I devote myself to maintain your house regularly? In order to maintain a value of your property, you must carry on the maintenance of your house. You're going to have a problem with the plumbing. You're going to have a problem with electricity sometime. Landscaping is one of those that they're exposed. So you have to make sure that you are able to maintain that. And if you, am I a new in Canada? So make, because if you are a new person in Canada, you have to learn about other obligations that you have in order for you to maintain your mortgage. Now, there are pros and cons in owning the house because when you buy a house, you have freedom to renovate because you own the house. You need to have a freedom. The but cons are that you have ongoing property taxes and other insurance expenses. So owning a house is a good thing, but also you have obligation to pay taxes. So owning a house is also a good thing because you have ability to build your equity and a secure investment. Property has been a very secure investment in the province of Ontario. For the last 10 years, the property value has doubled. So, okay, but sometimes if you are carrying a loan, that it will increase your obligation as a mortgage payment because interest rate will increase depending on how long you own the property. So if you own a property, you also have a potential of renting it. You can have a rental income, but it's also possible when you have a tenant, you might have to incur some more cost to maintain the property. So these are the few things that comes with the house ownership that you have to repair, maintenance of the house, and you deal with that. So now the most important thing is that what do you really need in order to get a mortgage? It's a good thing to own a property. So first of all, you have to think about that I need a mortgage. Okay, in order for that mortgage is thinking about buying your first property. Is that what you're looking at? Yes. You have to think about many things. Most important thing is when you are buying or thinking of buying a property, it is very, very important that you think about getting a pre-approval and lock down your interest rate. Mostly bank will give you lockdown rate for um, um, 120 days, 90 days, 120 days, depending on the how busy they are because of coronavirus. It has been locked down, and people are busy, and banks are very busy, so they may not process your pre-approval because they are busy with deferred payments and other mortgages. As you know, about 600,000 Canadian have asked for the deferral of payment. Now, what do you really need for the mortgage? And then we'll talk about how to get the mortgage and what other steps are. In order for your to get a mortgage, you need to have government issued IDs with a picture on it. Driving license, passport are few of those as required. They look at for minimum at least two. But if you have a driving license, that's one of the photo IDs that they need. And you need to have a contact information about your employer. That means you must be an employee. So if you have to furnish a letter of employment, make sure that it has all the contact information to contact your lawyer, your employer. Now, the third one is proof of the address. That proof of address will depend on two things. One, where you are living. Number two, which property you are buying. So you have to have evidence. In that case, you may have an agreement of purchase and sale that will show the address of the property that you are buying. And ID will tell you where you live. Then proof of income is very, very sensitive. Remember, we talk about the financial viability of a person to carry on this responsibility. So proof of income is if you are an employee, you get T4. So you need a minimum of 2 years of T4s. Okay. And also if you're a self-employed, for example, as a realtor, real estate professional like I am, they need T4As. So you need the T4As. And if you are a self-employed, the bank will also require, or lender will also require your T1 for last 2 years, because that T1 has a business portion. When you are not an employee or self-employed, there is an area which shows the gross income and also shows the expenses. Then is the proof of down payment. This is very, very critical. You must have a bank statement showing the money sitting in your account for at least for 90 days. And also, you need to find out if you are borrowing money. If you borrow money from your family, then you will not be, that amount that you borrow will reduce your value of the mortgage because it's a debt, it's a liability. Unless you get a parents, they give you money as a gift, and then they have to give you some sort of a statement in writing that this money is for gift, not to be returned to parents or friends or whoever give you the money. So this is very, very important for you to understand. Now, also proof of saving and investment. If you have RRSP, you have a savings, or you have a stocks, or whatever funds you have, cash sitting in your bank, RRSP, GIC, you have to provide that as evidence. Proof of payment. Proof of saving and investment, again, same thing. Whatever investment you have to prove. Provide the bank statements or GIC or whatever. Then you have to provide the current details of your debts. What are the liability? Mostly first-time home buyers will have student loans because they have borrowed money to go to seek higher education, and then they have the loans. Sometimes parents sign the loans, and parent signs it. Then, regardless of parents sign it, your name is on it. You have to declare that. You bought a car that you are paying, that you have to declare that. Any other liability, you bought some personal belongings, something that you want to use, and you are showing you have a MasterCard, Visa card, or American Express, any card, Future Shop card, Best Buy card, Home Depot card, anything you have, those are liabilities you have to pay. So you have to declare those. And lastly, your credit score. Credit score is very, very critical because that demonstrates your worthiness, your past pattern of being a responsible borrower who borrows money and also pays on time. And these are the preliminary thing I will repeat again. You have a government ID, you have a contact information for the employer, proof of the address, proof of income, proof of down payment, proof of saving and investment, details of current debts, and also your credit score. So these are the things you got to have in order for you to. So now let's say you are thinking about buying a house. So you have all those things piled up together. And before you go and apply, it's a good idea to apply for pre-approval, but sometimes you may not get it. But when you talk to a mortgage agent or broker, provide this information to them, and they give you some feedback and tell you what is possible for you and what is not, and what is the threshold. So there are some government programs that can help you. We're going to talk about those things. So first, you have a first-time buyer. You have not owned a property in Canada. This is number one. Mostly the declaration is about property around the world. But if you are buying the first time property in Canada, so that you will have two benefits. There are government incentive programs where you can benefit from it. So first time buyer, there is a federal rebate tax for $750 that you can claim. It was announced in 2009, and you can enter that on your tax return, line 369, if you borrow $750. The most important thing when you are looking for is the land transfer tax. They allow $4,000 land transfer tax exemption for you. That means if you buy a property for $368,000, there will be no land transfer tax. You also, if you go beyond that, you have to pay taxes, and especially if you go to Toronto, they have a two land transfer tax, one for the city, one for the government of Ontario. So you have to talk to your lawyer. When you are negotiating a deal, you have to make sure that you are able to talk with your lawyer and you are aware of that you are entitled to up to $4,000 land transfer tax. So this is a benefit. Now, second is the RSP. You can draw up to $35,000 worth of RSP when you are buying a home. I think there are conditions you have to talk to your bank where you have this RSP, whether it is for two people, is it $75,000 or is $35,000 for individual or a family. So there is a RSP contribution, and you have to pay this back in 15 years. 15 years you have to pay this back. So you are up to $35,000 RSP tax-free. You can take it out and buy toward purchasing the house. So this $35,000 is tax-free, that the money that you put in RSP. Okay. So you have to pay it back in 15 years. Okay. Now, there are some rebate available for GST, HST when you are doing your existing home renovation, but you have to talk to your accountant about that. The first important thing for you is to understand the government of Canada has issued some program where a buyer can, a first-time home buyer can take advantage of that. So it's called, I think they set aside about $1.25 billion for 3 years, and they call first-time home buyer investment. So, sorry, incentive. First-time home buyer incentive issued by CMHC. We're going to talk about that. This is basically is a equity sharing program. It is very interesting. If you are buying a house, a brand new from the builder, they will lend you up to 10% of the value you purchase, but there are criteria. And if you are buying a house from the market, which is resale, you can be entitled to get up to 5% of the purchase value. There's a limitation. There's people who qualify. The people, you have to be a first-time home buyer, and then your combined household income is 120,000 and less. This is a criteria. Your income must be 120,000 or less. There is also a threshold that the value of the mortgage should not be 4 times of that value. That means if your income is 120,000, if you time 4, it comes to 480,000. So value of your purchase should be 480,000. If you buy a bigger than that, you have to pay from your pocket. This is the criteria. And depending on where you live, where you want to buy, I have a couple of questions I'm going to look at my phone and talk about it. It says, what kind of salary do you need to qualify for a mortgage? It depends on how much you want to buy, what type of property you want to buy, what kind of income you have. So this is very important. We're going to talk about that as we move along. So with this program, even though it looks very attractive, but in GTA, Toronto, Mississauga, Brampton, it's very difficult to buy a home up to, let's say, 480,000, a half decent living space. Depends on what are you looking for. Some older properties will have a lot of maintenance cost. Anyway, it's possible to you might have to go a little bit away from the bigger cities and explore the possibility of buying a home. Now, so this program, which is a CMHC program, is that you borrow a money, and this is as long as you maintain the house and keep it for 25 years, you have to pay no interest on it. But if you are selling the property in between, then you have to pay back the amount that you borrow. And because it's an equity sharing, you have to give that percentage. I'll give you an example of that. Let's assume that you bought a house of 400,000. You took 10% from the government, which is 40,000, and you put yourself 40,000. Your purchase was 400,000. And let's assume that you sold that property for 480,000 after 3 years. So how they calculate the equity sharing is that 480,000 minus 400,000, that's 80,000 gain. And that 80,000 is times 5% at 10%. So $8,000 plus 40,000, you have to pay $48,000 back to the government. If you have this, so 48,000 you have to pay back. Now, if you have borrowed 5%, then you have to pay 4,000 plus 20,000 that you borrowed from there. So that means the government is sharing with you that 5% or 10% equity partnership that you have to pay. This is very, very important for you to pay that amount. So if you do not pay that amount, if you don't sell the property for next 25 years, you don't have to pay no interest on the property. So this is very, very important for you to understand how it works. So this program is available to all of you who are interested to participate. Now, the important thing about this is when you are seeking a mortgage approval, you have to justify that you are qualified. If you don't have that income to justify, you may not qualify for it. The important thing is to avoid mortgage fraud. Lots of things happen is when you are trying to get a mortgage approval that you have you are forced to, or you are trying to get a mortgage when you don't qualify. So that leads you to mortgage fraud situation where you don't qualify. Now, I'm going to take it is if you misstate your work position, your income, or length of time with the employer is treated as a part of the mortgage fraud. If you state you are a full-time employee, but you are not, that is treated as a fraud. If you misrepresent the amount of source of down payment, for example, you borrowed the money from your parents, but you say, no, this is the gift, that's misrepresentation. Claiming a rented property which is owned or occupied, but is not, is a fraud. Not disclosing other mortgage or debts is also fall into mortgage fraud. So you have to make sure that you are showing exactly what you are receiving at the moment. You cannot misrepresent. You cannot omit or inflate the value of the property when you are asking for a mortgage. You can only add the name of the people who are responsible and they're going to own the property. You do not include the name of the people who are not going to be responsible, or they're third party, they have a different interest in the property. You cannot do that. If you provide a borrowers who misrepresent information or a straw buyers who allow a property to be purchased somebody else's name, that's a mortgage fraud. So you have to make sure that you protect yourself and not to disclose information or disclose information that cause you to subject to a fraud. So how much is the question was, how big of a down payment do I need? It all depends on how much you have saving. You can put minimum for the first time home buyer is 5%. So as long as you have 5%, you can get 5% from the government. and the property that you have chosen with your broker or the realtor, that is the proper amount that you will be uh, paying it down. So down payment is depends on your what saving you have realized, and that's what you will be doing it. We're going to take a break for now, for a few minutes, and then we'll get back on Awaz Entertainment. We're taking a break for a few minutes. Welcome back to Awaz Entertainment or Mortgage Coffee Talk. So we were talking about special questions that we have from our audience. How do I know I am getting a good interest rate or not? So first of all, as a part of the due diligence, you should be talking to your broker. He will be asking you, um, uh, and also ask him to tell you how many people you have asked for the interest rate and how many people you applied for to make sure that you have the best deal. So you can check the lender's website, TD Bank, Royal Bank, CIBC, National Bank, BMO. They all publish their rates online. Now, your rate is based on what you can, based on your file, and you based on your credit score, based on your income, based on your relationship with the bank. The mortgage broker have the ability to talk to many banks to make sure who is offering the best deal will be presenting to you. So mortgage rate depends. It has a lot of factors involved with your ability to demonstrate creditworthiness and be responsible. So the rate will be determined by based on your credit score, the whole your file. So what is the amortization period? Amortization is the period when you borrow a loan. It has to be paid out in a certain period of time. So standard normal amortization period that is used is 25 years, for example. So your loan, you borrow 400,000 today. After 25 years, paying all the payment that you have, monthly payment, weekly, bi-weekly, whatever, that your loan will be paid out. So that's called amortization period. That means your loan is programmed for 25 years, 30 years, 10 years. It depends on your ability to manage your funds. So where I'm looking for to buy the property in the neighborhood? So it all depends on the value of the property. You talk to a realtor. I'm a real estate broker of record for City Pro Realty and fellow Real Estate Institute of Canada. I'm a certified international property specialist. So you talk to a realtor in your area, it will tell you based on your pre-approval or based on the funding that you have provided, the threshold, which area you are capable of doing it. Remember, if you go out of town because you get a better deal, two things will happen is, number one, your travel time will increase. If you are driving a car, your cost of gasoline travel time will also increase. So you have to, when you're looking at a house, you have to consider many points. If you have a small young children, you want to stay close to the school. is very, very important. You have a community center, the hospital, or fire station. So, and also, how far do you have to travel to your work? These are all related issues. They are they cost they increase cost for traveling between work and to your home. So you have to think about these all factors before you're choosing a property. So now the other thing is we talk about guarantor. There was a point here that what I do. So guarantor, when he signs a, a mortgage for you, some banks will like the guarantor to be on the title. So title could be 1%, but he will guarantee the mortgage is liable like a buyer. But guarantor will be pre-qualified exactly like you do as a new buyer. So it doesn't matter. Guarantor will the credit report will be pulled from the credit bureau. For all those things that we talk about, they will have to demonstrate the income, the credit, the property. They might have their own loans. You have to look over it, all of those things again, and they will provide a guarantor. And when the guarantor has signed that mortgage, the loan will be listed in credit bureau against them. So they cannot buy. It give them it reduces their ability to do more transaction because they have signed for your guarantor. So anybody can be a director. In order to be qualified, you must have an asset, you have finances, you have capacity, additional capacity to accommodate. Instead of buying yourself, you're going to help some family member or a friend to get the mortgage. That's what you have to do. So what are the frequent mistakes that home buyer makes, new home buyers? First of all is that you're not putting together your team. That's very important. When you are a first-time home buyer, you need to talk to experienced real estate professional to make sure that he connects you with the lawyers, experienced lawyers. He also talk to the mortgage brokers or lenders who understand your situation and can help to make sure that he can help you to get a proper mortgage. Now, also the home inspector, he has to help you to find good home inspector. We're supposed to give you minimum three referral program, so they can give you the mortgage, the inspection or the lawyer. We provide 3 referral to you. You pick and choose. But sometimes working with an experienced real estate professional help you to mitigate through all the challenges that you have. So when you talk to a lawyer, you talk to a home inspector, you talk to a mortgage bank or lender or a realtor, you have a full team working with you, and they understand what are your needs are, how much you can afford it, and they make sure they will find you the property that meets your needs, not the wants. Our wants could be anything, but what we can justify, what you can afford, because suitability is the key. What is your suitability? That's the realtor will do his part to make sure the property suitable for you. The lender will also will do his part to make sure that you can afford that mortgage that you are looking. So suitability will come. So when you are working with a team, this is the biggest mistake, is that you get someone who is inexperienced, he has no knowledge, he has never dealt with a first-time home buyer, and they don't put you to ease, and that is where you have a problem. So you can avoid those mistakes by getting an experienced person who has not only is a realtor, a regulatory requirement to become a realtor, but also they have additional designations. I have 6 designations in real estate: CIPS, SRES, FRI, CRES, SRS, ABR. These are additional designations that I was passionate about to help. Same thing in a mortgage. We have a mortgage brokers. I'm a principal broker, so I have a license, and I can talk about the mortgage. So this is why important for you is to check their credentials, talk to their friends and people who have dealt with them, and get some reference. So this is very important. Now, is what you look out for buying an apartment condo. Now, when you buy a property, the condominium is very different than it's a whole new subject about buying a condominium, because you have to have a lawyer involved, review their status certificate, and they look at the viability of the condominium. If you are buying a new one, you have to wait until the buyer, if you buy from the builder, you may be able to take possession of the property 6 months before, but the condominium will not be registered until 90-95% is sold. So you will be taking possession, and you're paying a sort of a rental to the builder. It will not go toward any mortgage or equity. It is just giving you possession, and you're renting your own condominium. And it's a very different subject. Next time I will be including that. But if you have a house that you buy, you look at the water leakage in the house. You also look at the mold and fungus. You might have to do those tests, so your home inspector can identify if there was a leakage, that you can see the moisture on the wall. By touching the wall, sometimes you can feel they're wet. They give you the impression there could have been a leakage there. So you can also ask the home inspector to do a moisture test to make sure. Fungus, there is an air pollutant in the air. I had experience one time that I was able to identify dust that caused fungus in the air, and we were able to get some discount because of a home inspection. We have inspector do the air pollutant test, and we identify that. So there are ways and means to verify. So you need to hire a good inspector. Sometimes you use infrared camera. Inspector pay extra $200 to get infrared cameras to see what's behind the walls. They can check that. Any cost that requires, because if you buy a house and you identify certain things, you have to have extra cost to repair those. If you don't have those additional cost of maintenance, maybe the bank or the lender maybe allows some provision for some maintenance, provided that you are able to qualify for mortgage. So remember, we talk about the home equity program. This is a very good program. So I'm going to share with you an example of this, which I mentioned before. So this is on CMHC website. If you ever want to check it out, you let me know. I can give you a CMHC number so you can call for the mortgage. I think I'm going to have it here. So I will have a number to report a mortgage fraud, and also CMHC, so you can call CMHC to get that number. So give you an example again. If let's assume you are buying a home, and the original price is $400,000. You took 5%, 20 of that from CMHC, and it's $20,000. And assume market value have increased to $480,000. Okay, so you borrow $20,000. So now equity sharing is $480,000 minus 400,000 times 5%, because you got 5%. So you will be paying 4,000 equity share of profit. So 20,000 plus 4,000, so 24,000 you are returning to you if you sell your house after 5 years. For example, whenever you sell it, when your first mortgage has ended. Now you have second situation is, let's assume that your mortgage goes down, your property value go down. Let's assume you bought it for $400,000 and you got 5%, which is $20,000, and you market value went down from to 330,000. So now you will take 330,000 minus 400,000. You have a loss of and it's multiplied by 5. So the equity portion loss is $3,448. That means you will be paying back to CRA, the CMHC, 16,550. That means they are sharing with. If it goes up, you pay 5% more. If it goes down, you pay 5% less. This is how the home share equity works with the CMHC. So you have to look into whether you are doing. So you can go to CMHC.ca, and there is you can type down first time home buyer incentive program, and you can see all these details on there. And this is very important that you will know. Sometime, for example, if the property goes, if you bought a 400, it sold for 520. So now there is a 14.2% appreciation. That means that you have a 520,000, you sold it, minus 400,000. So you have $120,000 profit. So 5% of that for the CMHC will be 6,000. So you pay 26,000 to CMHC when you sell your property. So they are equity sharing with you. There is no extra charge when you're buying it. To make sure you talk to your mortgage broker lender to see if you qualify. It raises the value of the property. But remember, you cannot go more than 480,000. If you go anything above that, you will be only given that portion as a support, and you will also be paying this money back. It is not a grant. It will be, you have to pay it back. So in case you ever need to know where to go and get this information, go to CMHC or give me a call. I will tell you whether you qualify. So this again, I'm going to summarize it again. If you are looking for a first-time mortgage buyer, you make sure you have a good team working with you. You have a realtor, lawyer, home inspector, lender, mortgage broker working together as a team to make sure that you are educated, take your time, and decide and make sure you qualify for the mortgage. It's very, very important for you to make sure that you are following all the guidelines that I have discussed in this program, and make sure that you are trying to do your best and provide. They need to verify your income. They need to look at your creditworthiness. They will look at the address of the property. I think I mentioned before to you again, just to summarize it again, make sure you have government IDs, you have a contact information of your employer, you have a proof of the address where the property is being purchased, which is the agreement of purchase and sale, proof of income. You have to have an income that's, you have a T4As, you have a notice of assessment for at least 2 years, and then you're going to have a pay stub for last three payments. Minimum 3 months or 3 payment of pay stubs. And you have a proof of down payment. You have to have proof of down payment, and also proof of saving in your bank and investment, and details of current debt, car, student loans, MasterCard, Visa card, all those loans that you have, those are debts, and source and your credit to make sure that you have been a responsible a person who has borrowed money in the past and used it, and then you have paid them and you have a good credit. Good credit score is 650 score and up. You may qualify for a little bit lower because you're a first-time buyer. So again, you can take advantage of CMHC, federal government's first-time home buyer incentive program, and have equity sharing with the with the with the government of Canada. So I take this opportunity to thank everyone for watching. Uh, Due to Ramadan, our time has been changed. I am very sorry for the inconvenience. We take this opportunity to thank our health staff, doctor, nurses, police officers, firefighting for their service to Canada, protecting us from against coronavirus. We hope that very soon we should have lockdown easing up. So from Awaz Entertainment and Mortgage Coffee Talk, thank you very much for watching. If you have any questions, please feel free to post a message on our website, Awaz Entertainment or Mortgage Coffee Talk. And I look forward to see you again next Wednesday at 6 p.m. Thank you very much. God bless you all. God bless Canada. Thank you.